President Trump's policies raising several caution flags, sending investor confidence on a roller coaster ride, mostly lower. Yet, according to our next guest, changes in Wall Street also highlight that Trump risk, but also expose other cracks in the market for retirement portfolios. Puck founding partner William Cohan joining us now to discuss. Bill, it's good to see you. This op-ed in the Times caught our eye because you talk about not just the damage that we're seeing President Trump's policies do to the market, but also sort of the backdrop of what has been a boom in passive investing. Why does that made markets sort of more vulnerable here?
Well, Julie, since the 2008 financial crisis, the Fed, regulators, Dodd-Frank has sort of mandated a complete change in the structure of the financial markets. Once upon a time, we would rely on stock pickers, people like Peter Lynch at Magellan, at Fidelity's Magellan Fund, who charged fees and made money based on the stocks in the portfolio going up. And nowadays, most investors are not interested in that anymore. They'd rather just put it in index funds that, like the S&P 500, that are sort of much more automated, computerized. The fees are much lower, and they basically pick a bunch of stocks and stick with them for a long time. And they change them once in a while, but not like a real stock picker would. And so, these index funds tend to chase stocks on the way up as they're going, like the Magnificent Seven. And so when the Magnificent Seven start cracking, that begins to influence the direction of the markets in an exacerbated way. And I think that's what you're seeing now. So, yes, there are still people who pick stocks, and there's still people who choose people to pick stocks for them. But most people now just invest in these lower price index funds. And those, as I said, those stocks don't change very often in those baskets. And then you've got like 10 or 20% of the market are, market makers who are trading in these stocks, in and day out. Citadel Securities, Point72, Millennium, places like that are just, moving the markets and exacerbating the trading in and out. So the combination of the two makes sort of a passive investor who's expecting, not to pay much, who's liked the ride on the way up, is now going to have to experience it on the way down.
You mentioned the Magnificent Seven there, Bill. What's interesting is one trend we've kind of noticed here is you have these strategists and they're coming out one after the other and they're cutting their targets, Bill. But one interesting thing is how many of them are still sticking with that Magnificent Seven. I mean, you saw even this week, Barclays, right? They joined in, they cut their target for the year, but they told their clients, listen, I mean, you stick with those big tech names because they talked about what they see as solid earnings growth and, hey, valuations, they don't look as stretched here. So it seems like those big names you're mentioning still in favor.
Well, look, I mean, there are seven of them. And so, a lot of the seven actually are not that crazily priced for the revenue and earnings that they're generating. The big one that makes people crazy and has made people crazy for years, of course, is Tesla, which, trades at, more than 100 times earnings. Anytime a stock trades at that level, you're basically asking for it. You're asking for huge volatility. You're asking for a correction. And people, of course, have lost a lot of money believing that Tesla was overvalued because it's become more of a meme stock. But, between Elon Musk becoming Mr. Doge and going into the government and hanging out in the Oval Office and taking his eye off the ball of Tesla, people are the sentiment seems like it's beginning to change. So if you're in an index fund, which probably has Tesla in it because, it was a great ride on the way up, now as it's going down, it's lost, 10 or 15% since the beginning of the year, you're going to experience it on the way down now. And that's just, the way it is. And but the other stocks in the Magnificent Seven, Apple or Microsoft or Google or Alphabet, they're more reasonably priced. They're still expensive compared to like, auto stocks. But, they're not going to be as volatile as the big kahuna in the Magnificent Seven, Tesla.
Right. And, I don't think anyone's chasing after auto stocks at this particular moment, Bill. Bill, I always like to talk to you also because you are well connected. You talk to a lot of decision makers on Wall Street and beyond. And I'm really curious what they're telling you right now, what you're hearing from them in terms of sentiment at a time when sentiment really seems to have shifted 180 from where it was after the election.
Well, Julie, as your previous guests have said, I mean, investors, CEOs just would like to know what's going to happen here. The chaos man in the White House who thrives on chaos on a daily basis, that's doing nothing for CEOs and investor confidence. You cannot plan. The irony is, he thinks these tariffs are going to somehow return manufacturing to the industrial sector in the United States. That's not going to happen if CEOs cannot nail down sort of what's going to be happening next. This uncertainty is driving CEOs nuts. And, people have said to me, look, if you're going to have, $2 trillion worth of tariffs, just let us know. If it's going to be $1.5 trillion, let us know. Let us know what it is instead of one day it's on, one day it's off. The market goes up, the market goes down based on whether or not the chaos agent is decided he wants to have tariffs or not. And CEOs cannot run their business like that, and they're completely fed up by this. And and then to say nothing of what the attacks that he's making on Wall Street law firms as retribution, that's got people nuts too, Julie.
Bill, always great to see you and have you on the show. Have a great weekend.
Thank you, guys.